Hello everyone, welcome to the 23rd episode of me learning how to trade using Forex. So in the last video we were going through the trading of indicators lesson in the technical analysis course on forex.com. We read through and made notes on the first few bits up until the moving average crossover section, and yeah, that's the bit where we got off. So we've got that chart there, which is that one there, and the 4 bullet points are written around here. So let's carry on from where we left off last time, which is moving average crossovers. So moving average crossovers, one popular way to moving average is to watch for crossovers. One popular way to MAS is to watch for crossovers. This involves using two MAS at once. Now, what does MAS mean? Do they mention it? MAS. Moving averages. Oh, just moving called moving averages. One popular way to moving averages is to watch for crossovers. This involves using two moving averages at once. One is slower, meaning it has a long-term time frame. One is faster, meaning it has a short-term time frame. Watch for moving average crossovers. This involves using two moving averages at once. One is slower. Meaning it has a long-term time frame. One is quicker, faster, meaning it has a shorter term time frame. A crossover occurs when the faster moving average crosses the long-term one. So that bit's the crossover there. A crossover occurs when the faster moving average crosses the long-term one. Occurs when the crosses the longer term one. Crosses the slower moving average. If it crosses from below to above, cross up, then it is taken as a sign that the market is entering uptrend. If it crosses from above to below, down, then a bear run may be on the cards. Wait, so if it crosses from below to above, crosses a longer term. If it crosses from below to above, oh, so a downward trend into an upward trend. Right, I see. So if the cross, if after the crossover, the trend turns from downwards to upwards, below to above, crosses up, yep, then it's taken as a sign that the market is entering an uptrend. Then it's a sign that the market is entering an uptrend. If it crosses from above to below, crosses from upwards to downwards, then it's a sign that the market is entering a downtrend. Market's entering uptrend, bear is going down. Bear run. Yeah, bear run is going down. Right, okay, so if the market is going uptrend, the levels at which the lines cross may also become a new support resistance area. The levels at which the lines cross, so that one there, may become a new support or resistance area. Which the lines cross may also become a support or resistance area. From here to here, copy, paste, like so. One drawback to me using moving averages is that they can be a heavily logged lagging indicator, as they require lots of past price data to function. As that they can be a indicator as they use lots of past Because of this, they may give false signals when the market move you predicted using the indicators petered out by the time you come to trade it. May give false signals. Hey everyone, so as I was rewatching the video, I realised that the rest of the video wasn't actually recorded because I think I accidentally hit my stop recording key button whilst I was typing. So but I've made all the notes though, so I guess I'm just going to talk you guys through what my thought process were when I was continuing on making the notes from the last video. So yeah, so I think in the last video, or well in this video I guess, we left off with that bit there, one drawback of using moving averages. So in my note section, I just wrote one drawback to using moving averages is that they can be a heavily lagging indicator as they use lots of past price data to function, which I think is what's written in the actual lesson, and may give false signals. And it says because of this they may give false signals when the market move you predicted using the indicator has petered out by the time you come to trade it. Okay, and then moving on from that, the MACD, as well as being used on their own, the moving averages form the basis for several other indicators, including moving average convergence divergence, or MACD. And I wrote that as moving averages can be used for other indicators, for example, moving average convergence divergence. When you select MACD on a chart, it will appear its own box, usually at the bottom. In the box you'll see three components: the MACD line, which is calculated by subtracting the market's 26 period EMA, which is exponential moving average, from its 12 period exponential moving average; the signal line, which is a 9-day exponential moving average of the MACD line; a histogram, which measures the difference between the MACD line and the signal line. I don't think I've written this in my notes. Oh, actually no, I did. Oh no, I did not. No, I wrote this bit though. If the market's 12 period EMA is above its 26 period EMA, then the MACD line will be positive. If its 26 period is above the 12 period EMA, then it will be negative, which is what I wrote. So if the market's 12 period exponential moving average is above its 26 period exponential moving average, then the MACD line will be positive. If the 26 period is above the 12 period, then it will be negative. Did you know 12 and 26 days are the standard settings on MACD, but you can tweak each to any periods that you like? I do not think I wrote that down. And then we got to the graph bit here, and the signal line is the dark blue line, and the baseline is that dotted line. The MACD is the light blue line, and we can see both here that they're the exponential moving averages for the corresponding ones. So trading with MACD. There are three main signals that traders will watch out for when using MACD: crossovers, zero line crosses, and divergences, which I think is what I wrote. There's three main signals to watch for when using MACD. Crossovers can indicate a trend is forming. If the MACD crosses above the signal line, it's a bullish signal. If the MACD crosses below the signal, it's a bearish signal, which is what they wrote here. So just like with the standard MA's moving averages, a crossover between the MACD line and the signal line can indicate that a trend is forming. If the MACD line crosses above the signal line, it is seen as a bullish move. If its opposite happens, it is a bearish move. We've got the zero line crosses, so if the MACD crosses below a zero line, it may signal a bear run. If it crosses above the zero line, it may signal a bull run. So alternatively, you can watch for when the MACD line crosses the zero line. If the MACD line crosses below the zero line, then it may signal a bear run. If it crosses above, it may signal a bull market. And then we've got the divergences, so the market's hitting new highs but the MACD indicator doesn't follow suit, meaning market indicators out of sync, a reversal may be at hand. And so if the market's hitting new highs but the MACD indicator is not following suit, then a divergence may be forming. This means that the market indicator out of sync and a reversal may be at hand. However, remember that an issue with the moving averages is that they can lag behind the market's live price, while MACDs, which is essentially an average of moving averages, can lag even more. So it is particularly important to watch for false signals and pay attention to your risk manager in using it. I think what kind of wrote is MACD, that should not be CA. MACD can lag even more than moving averages. And then to do the knowledge, EUR/USD's 5-day moving averages crosses above its 100-day moving averages. Is this a... So if it crosses, then I'm going to have to remind myself, what was it? Crossovers, so whoops. If the 5-day moving average crosses above, then this is a sell, no, buy. It is a buy. Crossovers. I remember doing this. Where was trading moving averages? Sell signal. crosses above its 100-day moving average. Moving trade. This involves two moving averages at once. One is slower, meaning as long, one faster. If after If after crossover the trend turns from downwards to upwards, then it is a sign that markets enter an uptrend. So in here, crosses above its 100-day. So if it crosses above it, then crossover when the faster moving average, and the faster one is shorter term, which is the 5-day one. If the 5-day one crosses above its 100-day one, so when the faster moving average crosses, if the crossover the trend turns from downwards to upwards, then it is a sign that the market is entering an uptrend. The levels that line. Wait. One is slower, one is faster. Crossover occurs when the faster moving average crosses the slow. If after the crossover the trend turns from downwards to upwards, then it is a sign that the market is entering an uptrend. So it is entering an uptrend because the 5-day one crosses above its 100-day one. So if it's moving in an uptrend, then if it goes up, then you buy because the price is going to increase, isn't it? The FTSE 100 MACD line crosses below a zero line. Is this a... if it crosses below a zero line, so what we wrote here is it may signal bear run. If it crosses above, so if it's a bear run, then you need to sell. Alright, so we've done that bit. Then I think we're doing the the 3 key indicators, which is among the multitude of available technical indicators, there are a few that are used far more than the others. Here are 3 to try out with your Forex.com demo. So Bollinger Bands. Bollinger Bands are another technical indicator to use moving averages in an interesting way, this time by plotting lines 2 standard deviations away from the market's moving average. They can help you visualize volatility and determine whether a trend is set to continue or reverse. So what I wrote was Bollinger Bands plots lines 2 standard deviations away from the market's moving average. Can be used on charts of any time frame. Help visualize volatility. Bollinger Bands take the form of 3 lines. So the middle line is the moving average of the given market, an upper band which is 2 standard deviations above the moving average, a lower band which is 2 standard deviations below the moving average. So I wrote, can be helpful when a market is in a trend and moves beyond the opposite band. Signifying a potential reversal. I think these bits shows up later in a lesson. So middle line is the moving average of the given market. The upper line is 2 standard deviations above the moving average. The lower line is 2 standard deviations below the moving average. So middle line is a moving average of a given market. It's a moving average of a given market, and then standard deviation is a measure of how close prices are to the average, which is what I wrote. So standard deviation is a measure of how close prices are to the average. So when the 2 bands are far apart, prices are far from the average, and the market is in a period of high volatility. When they're close, it is relatively calm. Have I wrote that? I guess help visualize volatility is what I meant there. Oh no, look how close the market's live prices is to either band. If the price is close to the other band, then it's considered high relative to the average. So if it moves beyond this upper band, it's overbought. Oh no, this is the later section. So I don't think I've written. It's when 2 bands are far apart, their prices of the markets are higher. I think I should write this down. Actually, this is useful. So standard image. When the 2 bands are further apart, prices are far from the average. and the market is in a period of high volatility. When they are closed, it is relatively calm. When closed, it's relatively calm. Okay, so that's that. Trading with Bollinger Bands. There are a few different ways to read Bollinger Bands. One of the most common is to look at how close your market's live price is to either band. So that's the next section here. Look how close the market's live price is to either band. If the price is close to the upper band, then it's considered high relative to the average. If it moves beyond the upper band, it is overbought. This could be a good time to short the market, aka sell the market, which is what I wrote. So if the price is close to the upper band, then it's considered high relative to the average. If it moves beyond this upper band, it is overbought. This will be a good time to sell the market. If the price is close to the lower band, then it's considered low relative to its average. If it moves beyond the lower band, it may be oversold, which could mean it's a good time to buy. So if the price is close to the lower band, then it's considered low relative to the average. If it moves beyond this lower band, it's oversold. This would be a good time to buy the market. And finally, the middle line. If the market is close to the middle line, then its price is fairly close to its average. If it isn't overbought or oversold, so no signal. Oh, it isn't overbought or oversold, so no signal is generated. So if the price is close to the middle line, then its price is fairly close to the average. It isn't overbought or oversold, so no signal is generated. And then Bollinger Bands can be used on charts of any time frame, making them useful to both day traders and long-term investors. They can be particularly helpful when the market is in a trend and moves beyond the opposite band, signifying potential reversal. So we can see there's a high volatility because the two bands are really far away from where the center moving at the average price is. So that bit is oversold because that went below the lower band. The low volatility shows here because the two upper and lower bands are close together, like near the center moving average. That's another oversold bit here. This is overbought because the red line is above the upper bands, and that's oversold. And then we move on to relative strength index (RSI). Another way to spot whether a market is overbought or oversold is by using the relative strength index indicator. Like the moving average something, isn't it? Moving average what's it called? Convergence divergence. This appears at the bottom of your chart and takes the form of a line that moves above and below zero. And what I wrote was relative strength index. Another way to spot whether a market is overbought or oversold takes the form of a line that moves above and below zero. So we can see that here. So I think takes the form of a line that moves above and below zero. RSI compares the average number of days that an instrument closes up to the average number of days that it closes down. This average is then listed on a scale of 1 to 100. So we've got the two lines here, below, above. What is it? Compares the average number of days that an instrument closes up to the average number of days. Average number of days. Oh, that does not make sense. Compares the average number of days that an instrument closes up to the average number of days that it closes down. So compares the average number of days that an instrument closes up to the average number of days that an instrument closes down. Oh, it doesn't make sense, I'm just reading it wrong. Right, this average is then listed on a scale of 1 to 100. This average is listed on a scale of 1 to 100. Typically RSI is used with a 9, 14 or 25 calendar day, aka 9, 10 or 20 trading day, because the Saturday and Sundays they don't work, period. If you add more days to the calculation, the value is usually taken to be less volatile. So typically used with a 9, 14, 25 calendar day, 7 or 7, 10, 20 trading day. If more days are added, the value becomes less volatile. And then trading via RSI. The typical way to read the relative strength index is that a value of under 20 suggests that market is oversold, whilst a value above 80 suggests that it is overbought. So RSI value of under 20 suggests that market is oversold, or an RSI value of 80 suggests that it is overbought. As with Bollinger Bands, if a market in a strong uptrend sees its RSI move above 80, the trend may soon come in for a reversal. Likewise, a value under 20 may signal the impending end of a bear run. So, if a market in a strong uptrend sees its RSI value move above 80, a reversal may come. A value under 20 may also show a reversal. However, these signals are no guarantee of a move, so caution is advised. Using RSI on your Forex.com demo account, log into a Forex.com account, bring up the market's chart, hit indicators at the top of the chart, scroll down to the relative strength index and select it. The RSI will now appear at the bottom of your chart. Right, okay, so stochastic oscillator. The stochastic oscillator works a bit like the RSI indicator, but instead of the averaging out how often the market is closing up or down, it compares an instrument's closing price to its average price over a given period. So stochastic oscillator compares an asset's closing price to its average price of a given period. Closing price to its average price over a given period. Like the other indicators listed here, the stochastic is mostly used to find overbought and oversold markets, as well as helping you identify possible entry and exit points. So, what I write here? Mainly used to find overbought or oversold markets. The stochastic oscillator is formed of two lines on a subchart. The percentage K line compares the market's close for the day to its trading range over the past 14 days, and the percentage D line is a signal line. In this case, a 5-day SMA of the percentage K line, and the SMA is a simple moving average. So what I wrote, formed of two lines on a subchart, the percentage K line compares the market's close for the day to its trading range over the past 14 days, and the percentage D line, which is a signal line. To calculate percentage K line, you take the market's lowest point over the past 14 days, not including today, away from today's close price, and times that by 100. Then you divide that figure by the range of the past 14 days. So its highest point minus its lowest point. This creates a figure between 0 to 100. I don't think I wrote that calculations down. Yep. As ever, you don't have to calculate a 14-day stochastic. You can use almost any number of periods. So trading with a stochastic oscillator like RSI or relative strength index, a reading above 80 or below 20 on the oscillator is usually taken as either overbought or oversold. So a reading above 80 or below 20 shows either overbought or oversold. However, as with MACD, you can also use the stochastic to look for crossovers. Most traders use both in conjunction, waiting for a crossover when the indicator is already above 80 or below 20 and taking that as a buy or sell signal. For example, when the percentage K line rises above 80 and then crosses the percentage D line, you may have a strong sell signal. So I think that's the percentage K line, that's percentage D line. Yeah, so when it crosses percentage K, when it crosses above 80, that's overbought. When it crosses below 20, then it's oversold. Signal line. Yeah, that looks about right. And then to the test your knowledge. If a market's relative strength index is above 80, could this be a signal for? So if it's above 80, then it's overbought. Yeah, if it's overbought, then you need to sell it. AUD USD's live price is close to the middle line of its Bollinger Band. Could this be a signal to you? Neither, because it's near the average. And I think that is all the lessons in the technical analysis course. Yes, it is. Right, okay, so technical analysis, that is done. Right, that is done. Yep, 3 key indicators. And now, so we've done all the intermediate courses, and now in the next video I'm going to start looking at the 3 advanced courses that that's left on the forex.com. So yeah, thank you for watching, guys. I'm going to unbind the stop recording button on my keyboard so that it's nowhere near where I'm typing, and hopefully there won't be any more random cuts in the video. So yeah, thank you for watching, guys. I'll see you guys in the next video. Peace.